A very warm welcome and welcome to HYCM's webinar with myself, Charles Coughlin, the Chief Currency Analyst here at HYCM. In this webinar, I'm going to be showing you what's driving the markets at the moment, the fundamental aspects which are driving different markets. Going to run through that with you. It's going to run through gold, copper, oil, as well as the currency space. So hope everybody is doing well. Just going to take a moment to welcome everyone. If you could let me know that you can see my screen and hear my voice, that would be great. Nice to have a number of you here. Nice to see some familiar faces. Will, Warren, Titus, Shwa, great to have you. Salman, as always. Kingsley, good to have you. Hasib, Padman, Abdul, good to have some familiar faces here. Looking forward to just explaining what's going on in the markets. Now, the very first thing we need to be aware of for this week is what's driving the markets. What's the key picture? Now, the key picture driving the markets at the moment are expectations of a US stimulus bill. Now, the US stimulus bill is a bill that's being debated in the US, and it's expected to be somewhere between about $1.8 and $2.4 trillion. Enormous. Now, those kinds of bills, that kind of stimulus, if and when it gets passed, is why the equity markets are rallying hard. If you just take a look at the S&P 500, you can see the S&P 500 is rallying on expectations of the stimulus bill being passed. Same here with the Dow, same with the Nasdaq. We can also see equity markets ripping higher in the DAX, the Australia 200, and the Euro stocks as well. So point number one, understand.
And on the geopolitical front, as according to Sky News Arabia, Nagorno-Karabakh authorities have announced the downing of a Azerbaijan warplane. It does come after Armenia and Azerbaijan agreed to a temporary ceasefire over the weekend.
Close off my squawk. There we go. So these equity markets that are pushing higher across the board, you can now see my screen. This is giving us that positive risk on sentiment. Now, in risk on markets, what we'd expect to see is gold markets rising. This is what has been pushing higher the gold market. You can see gold pushing higher through this trend line, finding some support around this 1920 region, looking to threaten to push higher. We've seen silver prices pushing higher, copper prices pushing higher. Copper is the commodity that is the commodity of global growth. When the world is doing well, the world needs copper. They need it for building, for wiring. With all the green technology that's about to be released, that all requires conductive material. Copper is the go-to. And in fact, copper is often called Dr. Copper, because Dr. Copper tells you the verdict of global growth. You can see this huge move to the upside and all these copper buyers that have been in place due to that anticipation of good global growth. So first thing, the risk on sentiment is supported by this narrative. Now, the dollar has been trading like a risk currency recently. What you notice is, if you see here S&P 500, you see that as the S&P 500 falls, the dollar rises. You see here when the S&P 500 fell, it rose. When the S&P 500 rises, it falls. So number one, a positive risk environment results in weakness for the dollar. Now, the dollar has medium-term weakness in play. Now, you can see here, technically, the dollar is just crushed out of this large monthly trend line. Prices held below that trend line and looking to move lower. The rationale, low US rates, huge amounts of quantitative easing. If Joe Biden becomes the US president, that will result in further US dollar weakness because he will stop the protectionist policies of President Trump. So all the protectionist policies of President Trump will be reversed, and this will be great for global growth, but further dollar weakness. So The dollar weakness story is firmly in play, and anticipations are that the dollar will keep weakening over a 6-month time frame. So that's what's primarily driving the markets at the moment. That's what's been pushing the euro US dollar higher, pushing the pound higher, New Zealand, Australian US dollar higher. It's also what's been pushing the US dollar, Canadian dollar lower, as well as some very good jobs number out of Canada last Friday. So the big narrative, the big picture in the markets at the moment is this US stimulus, expectations that it will be passed, whether it's Biden, whether it's Trump. Now, this is what we have to watch, okay? At the moment, President Trump is behind in the US polls. We have Joe Biden in the lead. As long as Joe Biden is in the lead and that lead is growing, expect more dollar weakness. Now, today, the US, North America are on a holiday. So it's likely to be quiet in the markets. Now, the reason we're seeing upside here in these markets here is because these are future markets. This is the S&P 500, Dow Jones, the NASDAQ futures. So the futures markets are still open, even though the cash markets in the US are closed. And if you just take a look at European equity markets, look, we can see a broad sea of green. European equity markets higher. We've got China's Asia Pac equity markets moving higher as well. The anticipation here is risk sentiment is still on. It's good for risk. So in this environment, what we're expecting is further dollar weakness to keep the major pairs supported. Now, we're also expecting further upside in commodities, copper, gold, and potentially oil. Now, oil has its own drivers, and there's a few reasons for oil's weakness today. First of all, there was a strike out of Norway that was due to take place. Norway exports oil, so if there was a strike by Norwegian oil workers, that would mean that there's oil prices would have reasons to increase. Norway's oil strike is now called off. They've managed to reach an agreement, so that's been negative for oil. We also had Libya. Their production is due to come back online. So the civil war and the difficulties in Libya had stopped some Libyan oil production. That's due to come back online. That's negative for oil. We also had the Gulf of Mexico was being shut down due to the hurricanes moving over. That's opening up. So that's why we're seeing some negative pressure on oil at the moment. And also because of COVID-19, with restrictions taking place across the world, that's all negative for oil. Airlines aren't flying, people aren't moving, trucks aren't shifting around. That's a negative pressure on oil. But broadly, commodities, they are supported on a weak dollar. Okay, so this weak dollar story is supportive for commodities. So, learning point number one is that as long as that dollar is weak, as long as Joe Biden's extending his lead, we can anticipate more upside in gold and silver. So gold and silver should be supported on that. Similarly, of note, we are seeing Bitcoin being supported as well. Bitcoin is supported on this weak dollar as well. I'm seeing this nice strong breakout of this move to the upside. So strong breakout on the daily chart, expecting it to be supported. And looking at the monthly chart, you can see this very strong trend line. A break and close above that monthly trend line, or if you go down to the weekly, a break and close of that weekly trend line will be even more bullish for Bitcoin. So that's one to look. More conservative traders will be looking at taking a break of that weekly trend line. So a break of that area there, around that 1200 region would be potentially good for that 1250 would be potentially good for Bitcoin buyers. There's a lot of fundamental strong reasons for Bitcoin strength going through. And in fact, I wrote an article on that very point today. Let's see if I've got it here. Yeah, I'll just give it to you. I write a regular blog for forexlive.com. As well as my blog, the HYCM Lab. I'm just going to send it to you here on the attendees. I'm just going to give that here. Yeah, okay, that should have gone to you all, and you can also find that on my blog here, which is well worth. Make sure you're tuned into this blog. I've got some great information that I put on this every single day, so I'll just send that out to you as well. Make sure you're on that situations there. Okay, so that's what we're expecting going in. Now, as we go forward, what else should we be looking at? Well, the main things we're looking at this week for the pound is Brexit risk. We've got a big week for Brexit risk. Just a quick reminder that as we're going through different entries, exits, that this is not trading advice. This is education. You can see how I'm making decisions for trades that I'm in, etc., etc. Like Brexit is in focus for the pound. The deadline day is this Thursday, October the 15th. Okay, so the euro pound has largely been range bound. The Brexit mood remains positive and markets are expecting a deal outcome. So at the moment, the expectations are that a deal will be done. So that is where we're at. So that means pound's upside is limited because a deal is kind of expected. Now, looking at the timeline, you can see the key dates. The 15th to 16th of October is the EU Council meeting. That is why the UK has chosen this date to be the deadline, because they want to have a deal ready to be agreed by the EU Council meeting. And the UK have said that if we don't get that deal done by that deadline, it's a no deal. So the risks are, if we do get a no deal, that will be heavy pound selling. So make sure you're tuned in this week to what's going on with the pound. And if you are trading the pound, you have to be aware of this. So there could be a good trade at the end of this week, regardless of what happens. So if it's a deal, there could potentially be an upside to chase. And if there's a no deal, there could be a strong downside to chase. So be aware of that coming in to this week. Now, also, the pound upside is likely to be limited because remember, the expectations is that a deal will be done. So the best trade is if a deal isn't done, then that's the heaviest pound selling. Now, even if a deal is done, the situation for the UK is still hard because COVID-19 cases are rising in the UK. There are large job losses expected. Over 500,000 job losses are expected. There is a slowing of the UK economy. So even if we see some upside due to a Brexit deal being arranged, expect to find medium-term sellers. So that upside, I'm not expecting that to last because I think a lot of that pound upside is priced in. That's what the market's been expecting for quite some time. And if you just have a look here, I'll take you over to the charts and you can see, looking at the pound, you can see all that upside in the pound moving up towards 1.3500 nearly. So if a deal is done, yes, of course, I can see a test back up towards that 1.3500, but I wouldn't be surprised if that became a double top. So keep an eye out for that. If there is a deal, expect the upside to be limited. I don't think it's going to go on and on and on because of the risks that I've already outlined. Rising COVID-19 cases, more restrictions hitting the UK today. We've got job losses, we've got limited job support scheme, we have got reasons for weakness over here in the UK. Let's just go back now to the main screen. These are some of the key issues that are still to be agreed with the EU: state aid, fishing and equivalents for financial services. These are pretty key issues. So you can take a quick screenshot of that if you're not already familiar. But these are the main deals that are really dragging sentiment down, is really making things difficult. Another issue that we had recently that kind of limited a little bit of the risk on sentiment was strength in the yuan. Now, the Chinese yuan, you can see here, has been strengthening the last 3 months on the dollar weakness. So what the People's Bank of China did this morning is they were getting concerned about this strength in yuan. So they've taken some action to weaken the yuan. by saying that financial institutions don't need to set aside cash when purchasing foreign exchange for clients via derivatives. So they're taking away a 20% reserve requirement that was held in place. This has served to weaken the yuan. So there's no longer such a demand for the yuan. It was a deliberate move by the People's Bank of China. China doesn't want a very fast, strong yuan, okay? It impacts their exports. If they have too strong a currency, it's not good. So they wanted to stabilize the yuan. And obviously they're seeing that if Joe Biden is ahead in the polls, that's going to add more US dollar weakness. And as you can see here, the dollar weakness tends to result in the yuan strength. So you see here, when there was that strength when there was the dollar index, you can see that move in the dollar index was higher here. You can see that huge upside in the dollar index resulted in the yuan weakening, and you can see here the weakening in the dollar is strengthening the yuan. So that's why the People's Bank of China have acted today. Looking ahead at the euro is vulnerable. So there's a very, very low number of short positions in the euro. There is vulnerability to ECB if they start talking about easing. Now, a number of ECB speakers were out on the wires over the weekend. We had ECB's Lane saying that the inflation outlook for the Eurozone is weak. We'll come on to the inflation due out later. We also saw ECB's Visco saying that the ECB monetary policy must be expansive. There's a deflationary risk. And Kazmiri said the ECB is to do everything that it can to ease inflation. So the ECB really do not want a strong euro. This hurts their export economy. So they want to keep the euro as weak as possible. So there is risks here for euro weakness coming up ahead. But obviously the euro will be mainly driven by this dollar. And if the dollar keeps being weak, then that does support euro-US dollar upside. So there are some conflicting pressures on the euro, but be aware of that going into the session. Now, looking for the actual week ahead, we see that the calendar is extremely weak. We have some inflationary data out of the US. Again, low inflation expected, very, very low, around 0.+2%. We also have core CPI, PPI data coming out of the US. This is seen as a good indicator of inflation. If you start seeing PPI moving higher, generally it's a front-running leading indicator for inflation. Got Governor Lowe speaking, so that'll be of interest for the Aussie-New Zealand dollar pair. Just taking a look at the Aussie-New Zealand dollar currency pair. Let's see if we can find that here. You can see here the Aussie-New Zealand dollar pair has been pressured recently as the RBA and the RBNZ come closer to one another. The RBA now expected to cut rates at their next meeting in November. The RBNZ expected to move negative next year, so there's more of a range-bound action. So the market will be looking careful attention to exactly what Governor Lowe says on Wednesday. Now, a little trick here is to see what Governor Lowe says. If he starts talking back on a rate cut, so if he starts saying, you know, we don't think we're going to need to cut rates, or the situation is better than we expected, if he's positive, then look for some strong Australian New Zealand dollar upside and look for a target around that 1.10 level. Now, one little trick here is if you just take if you look at Australian 10-year bond yields, and if you subtract the Australian 10-year bond yield from the New Zealand 10-year bond yield, what you get here is this line, okay? Now, the bond yield spread, this is the bond yield spread between these two nations. The way to understand it is it's like a risk profile, okay? So this tells you the relative risk profile between Australia and New Zealand. As the yield spread rises, it means that Australia is anticipated to do better than New Zealand. As this yield spread falls, it means that Australia is doing not so well compared to New Zealand, okay? And that's the general way. So that's why you see the currency markets tracking the bond markets. They're very, very closely linked because they're so connected to interest rates. Now, you can see here that the bond yield spread between Australia and New Zealand dollar has now broken through these recent lows here, okay? So that says that the situation is worsening for Australia compared to New Zealand. So that's why this upside pressure is not expected to carry on. However, if on Wednesday, if Governor Lowe says that the situation is better than anticipated for Australia, that that they may not have to cut interest rates, then a divergence opens up between Australia and New Zealand dollar, and that will be more upside for the Australian New Zealand dollar. We'll see this yield spread moving up because Australia will be doing better compared to New Zealand, and this will follow suit. First target up at 1.100. So going into the week ahead, that's a key event to be looking for. Also, a trade that I'm in, I'll just run that through with you. Let me just find the right now. This is, let me find an index. Just want to find the right. Let me just find it for you. Where is it? Where is it? So it might be this one, S and B, T. Oh, let me just, right. Bear with me. It's annoying sometimes when you can't remember the code for the, I'll just go to a different screen and I'll quickly find that for us. Okay, let's have a quick look. Bear with me, and I'm just looking up the code for the S&P 200. So I'll just look at that there, and I'll be with you in 2 shakes of the donkey's tail. Just looking up the number, and there it is, XJO. See, it's quite counterintuitive, that S&P 200. Now, this is the S&P 200. Okay, so this is a trade I'm in. Now, my rationale for this trade was very, very simple. Okay, so first of all, it was looking at a very, very simple trend line break. You can see here, trend line from here and down to there. And I entered in last week when that trend line broke to the upside. Right? Now, my rationale for this was as follows. Australia has a huge stimulus package now. They released a new stimulus package last week, and that's a tremendous support for the ASX 200. Equity markets in Australia will be heavily supported by lots and lots of fiscal stimulus from the government. Upside for Australian equities. We also had the fact that the Australian dollar is been weakening a bit after the Reserve Bank of Australia moved towards a rate cut. That's better news for Australia's exporters. We have huge amounts of stimulus out of China. China has around 30% of Australia's GDP comes from its trade with China. So a booming China is also a booming Australia. So putting that all together, it was a nice buy on the break and looking for upside around that 6.49 region. So looking for a move up just underneath 6.500. So that was a trade there I took on the Australian dollar. Any retracements back to this trend line, I would anticipate as suitable still for longs. Looking Further afield into the week, we see that we have the we have Chinese inflation data, which is important. We also have European CPI data, which is important on Friday. Now, expectations are that there's heavy deflationary pressure. You can see here that, look, minus 0.3% expected. So heavy disinflation. The lower that is, the worse that is for the euro. So if that comes in at like minus 0.5 or 6, then that's going to result in immediate euro downside. So watch out for this event. It's not marked as a red event on the calendar, but it is important. So make sure you don't miss that, particularly if you're trading the euro. And retail sales are out for the US. That's important because the US consumer is the big driver of the US economy. So this will let us know how the US consumer is doing, obviously alongside stocks. I'm going to go to the questions and answers now. And Shra's got a question, and he says, Brexit seems to be no deal at all. Bank of England also say they are ready to cut interest rates to 0 and negative. That's right, Shra, good point. The Bank of England are opening up potentially to negative interest rates. Now, they're not there yet, but they're moving towards it. So that is a negative to the pound going forward. There still is a deal anticipated, Shra. That's the mood. The mood in the financial markets, the mood across the wires is that a deal will be done. So don't underestimate that deal. But obviously, if a deal isn't done, that's when we see the heavy selling, and you'd expect, a move back down to 1.20 on the pound. So that's the risk. It's tilted that way. Yeah, another question from Shra. Aussie, New Zealand did a long due to break out the trend line upside. Now, that's where I'm going to have to say I'm not convinced on that. Now, the reason is as follows. Right, let's just move it. Let's just go back to the Aussie New Zealand dollar. Remember, try look at this yield. You see this yield spread? The yield spread is moving lower. So that means the outlook for Australia is now worse than it is for New Zealand. It's worsening. Can you see that when the yield spread falls, look, the Australian New Zealand dollar falls as well. When the yield spread rises, the Aussie New Zealand dollar pair rises. Okay, so look how tight that correlation is. You can see right back from March, when the yield spread falls, you've got pressure on the Aussie New Zealand. When the real spread rises, the Aussie New Zealand dollar rises up. So look at the moment, Shra. Yeah. Have you got a trend line break? Yeah, sure, you've got a trend line break. This is what Shra is saying. I got this trend line break. But do you have conviction on that? No, Shra, because the yield spread is moving lower. Now we know the Reserve Bank of Australia, they've moved towards cutting interest rates now, Shra. The Terry McCrann, the famous RBA watcher, has now shifted to expecting an interest rate cut out of the RBA at their next interest rate meeting, which is like November. Okay, so next month, about early November, 3rd of November, I think, we've got an RBA meeting. Here it is, the RBA rate statement, November the 3rd, and they're expected to cut. So that means that bond traders, look at them, that risk profile has gone lower. Risk traders are not expecting more upside. So yes, technically, Shra, you're right. There is a nice upside break. And if you were just looking at that technicals, sure, but we're not. We're fundamentals as well as technicals, and the fundamentals are not good. Now, I showed you the trade I was in, that S&P 200 trade, and there we saw, look, yes, there we've got the trend line break, Shra, and the fundamentals are with it. Do you see? That's what we're trying to do. Combine technicals and fundamentals, and then look, that break is solid, isn't it? Look, it's gone up, it's gone up, and it's up. So since the break about 1, 2, 3, if today closes up, so that's 4 days to the upside. That's the kind of trade you want that go in one direction. Yeah. What will be the possible impact of a digital euro on the currency? Now, I'm not sure what you mean by a digital euro, because sometimes euros are digital, aren't they, Titus? Like the money in our bank accounts is digital. I've got digital pounds in my account, so money can be digital. So I'm not sure what you mean by that question. Warren, everything seems geopolitical now, US stimulus and Brexit. Warren, yeah, exactly. And with so little data going on this week, you know, it's likely to be a sentiment-driven and a geopolitical-driven week. Is the time to trade on euro US dollar or have to wait? Like, you know, for me, the euro US dollar is just a wait, because I'm expecting dollar weakness to carry on. So with the US away on holiday, personally, I'm waiting on the euro US dollar. That's my take on it, Lali, really. Will not a strong euro work against euro economies? Yes. Will there be any actions from Eurozone governments? Most likely. Padman, you're right. A strong euro hurts the European export economy. The ECB have said they don't like a strong euro. They haven't said a price at which they will intervene, but they don't like it. So over the weekend, what we saw, Padman, we saw ECB's Lane, we saw ECB's Visco, and ECB's Kazmiri all trying to talk down the euro. So they will interact, they will act. But remember, at the moment, they are potentially fighting this dollar weakness story. This dollar weakness story is driven by a Biden lead in the polls. As long as Biden is winning in the polls, you can expect this dollar weakness to carry on. If that narrows, if Trump starts to get closer, then we'd expect dollar strength, because President Trump has protectionist US policies, that's dollar positive, and we'll see euro US dollar downside. So that's the thing to be looking at, what's going on with the stimulus bill as well. Euro on risk due to ECB meeting 3 times this week. Yeah, you have got to keep a careful eye on euro, and remember, the big daddy is this inflation data coming out on Friday, Schwab. If we get low inflationary data, then that's going to give heavy pressure into the euro, as markets expect some more easing, more action from European markets. Now, one interesting trade for this week that I've entered is the euro Aussie dollar short. Basically, I looked at a euro Aussie dollar short for the simple reason that, here we go, for the simple reason that you've got rising COVID-19 cases, weakness for the ECB, and Australian dollar, Australia slightly better coping with COVID-19. So that was my rationale. My entry, very simple, just a simple trend line break here on this daily chart. And just as long as price remains below this trend line, I favor shorts. Price gets back above here and I'm closing out, just expecting more downside in the near term. So that's one trade that I'm looking at for the euro Australian dollar. Okay, everybody, thank you all very much for the session. It's been really good to have you all with me. Remember, if you're not yet a HYCM client, don't forget that we have a number of different packages that I have put together to help people trade and help people trade alongside me. So please do have a look at the link I'm sending you. And remember as well that for those of us who are HYCM members, I have another webinar which I'm running on Wednesday. So do have a look at that. And thank you all very much for your time. I hope you have an excellent week, and I look forward to seeing as many as I can of you on Wednesday. Yeah, Warren, same concept with Euro New Zealand dollar as Euro Aussie dollar, exactly the same. Thanks, everybody. Take care now. Goodbye.